Hi everyone, and welcome to today's webinar, Making Sense of Personal Finance. My name is Lynn Mattis, and I work in the Alumni Relations Office here at Mohawk College. I'm so glad you're able to join us today and look forward to learning alongside all of you. It is now my pleasure to introduce today's webinar guest. Our presenter is Michael Elliott. Michael has 25 years corporate finance and treasury experience at all levels of banking and insurance industries. He is a lifelong learner of personal financial management, investments, and estate planning so he can help himself, family, and friends. Michael is a board member and treasurer of Kiwanis Homes and the John Howard Society, as well as a popular finance professor at Mohawk College. He is also a graduate of the Business Administration program at Mohawk. Thank you so much for being here today, Michael. I'm really looking forward to today's presentation. And with that, I will hand the microphone over to you.
All right. Good afternoon, everybody. Nice to see you showed up on what turned out to be a pretty nice afternoon. So we're all looking forward to getting a bit of fresh air this afternoon. Today, as I was just speaking with Lynn before we opened up the meeting, as I ran through my presentation this morning, I noticed that in order to make it fit into 45 minutes, we're covering a lot of ground. We may find that I'm actually just creating more questions than actually answers. But that's good, because if it gives you something to follow up on or something to investigate that you weren't aware of or weren't thinking about before, then then we've probably won. And that actually brings me to today. So my goal of today's presentation, at least from my point of view, is that you learn one or two things you didn't know, or one or two things that you can use, one or two things that send you in a different direction than you might have if you'd made the same decision this morning. So if we hit that, then I think we're successful. I go to sessions like this as you're attending today, and if I can walk away with one thing, and next year I go to another one of these things and I find another great thing, then that's good. I don't think all of it's going to apply to you, and but I'm just going to cover a bunch of topics in hopefully an organized manner, and then we'll and hopefully a little bit of it makes sense or resonates, or you can use it going forward. So what I sat down and thought about, what do I want to talk about today and how does it fit? The first thing I just came up with was just this, what I call the life cycle, where you at some point you start earning, and then as a result of earning, then you can spend. You can also save. Once you're saving, then you need to invest. Investing, that process creates taxes. You probably need to have a bit of an insurance plan, eventually retire, and then finally you have your estate plan that you execute, right? And so if I think about that from start to finish, that's kind of the whole spectrum of personal finance. And I might have missed a couple of things, and some experts might add a few extra details in, but largely this was it. In today's presentation, what I'm looking to do is kind of focus in these areas, right? So we're going to talk about spending, saving, investing, and a little bit about taxes. There's a lot more, and even within these, I could probably do 2 8-hour sessions on the full cycle. So, we're just going to scratch the surface. And again, hopefully we can find something in each spot that is helpful for you. I was aware of this quote from Dickens that basically defines happiness as spending a little bit less than you earn, and that spending a little bit more than you earn eventually results in misery. So he defines happiness: if you annual income 20 pounds, annual expenditure 19 and 6 result happiness. And then the opposite, spending just a little bit more than you earn every year, the result is misery. And and if you ever read any of these books, I didn't, but my wife was a big avid reader of books from these time periods. They had debtor's prison back then too, for people that couldn't afford to pay their debts. And so we're going to start in that life cycle we talked about. I'm not going to really talk about earnings so much, because I don't feel that there's much value I can add you there. Let's talk a little bit about spending. So the key actually to saving is spending less. It's possible that finding extra income will help you save, but really at the end of the day, I know lots of people who are, lawyers earning $250,000 a year, I shouldn't say lots. I'm aware of people, I've met people in the, making phenomenal amounts of money. Husbands and wives, their household income is $300,000, $400,000, and they're struggling to manage their debt. You spend what you make. And so the real key to saving is controlling your spending. And it doesn't matter if you're earning 40,000 a year or 300,000 a year. It's the same problem that we all have. Spending's fun. It's one of the lines I like for weight loss is it's more fun putting it on than taking it off. Spending money is more fun than not spending money. And often in your lifestyle, it's also not even a luxury. You've got a young family, you've got, issues. There's just a lot of things where you don't have a lot of discretion. And so controlling your spending is a difficult thing, but it's also the only thing that works. So we have to find ways to creatively try and spend a little bit less. In preparation for this session, I watched another course that was teaching people about personal finance, and a gentleman got into talking about the marginal utility of spending. And if you remember your economics courses, they talked about marginal utility, the idea of diminishing returns. And that the way my economics teacher explained it to me was, late at night, you order a pizza and you finally, 45 minutes later, it's delivered. That first slice of pizza tastes the best. You'd be willing to pay the most for that first slice. The second slice is okay. The third slice, by the time you get to the third or fourth slice, they're just fine. But the first slice was worth a lot. And the idea is that, more of it is probably worth a little bit less to you. In the terms of spending, there's the way you could essentially have bought a smaller pizza and spent less. Because if you recognize that having two small pizzas, having the first slice 4 nights in a row, rather than having 4 slices all at once, is actually more utility to you. So, buy a smaller pizza and spend that money on a further pizza later. You're getting twice that first piece, the best part of the pizza being the first piece. And marginal utility can do everything from buying a car, a basic car that gets you from A to B. A used car might cost you $10,000, $15,000. But if you want a fancy car, if you want one that looks really sharp, if you want one that has all these advanced features, if you want a newer car, you're going to spend a lot more. But arguably, the marginal utility is diminishing. So you start spending a lot more to get less value. At the heart of it, what was important was a reliable car that gets me from A to B. And I'd be willing to pay a certain amount for that. And that's probably the most important thing. And so when you spend more than that, once you spend the money, you can only spend it once. So it's gone. You can either spend it or save it. And so the idea of trying to trim back your spending and find ways to do it while still maintaining the maximum amount of utility is kind of what this guy was getting at. I dovetail it back into spend better, know your prices, be skeptical. It's marketers' job to separate your money from you, right? They're ruthless. They're looking to bait and switch you. They want you to come in and see this great deal. Oh, but while you're here, buy this other thing that's high margin that we make a ton of profit on. Costco is a great example. Costco, you can save a lot of money shopping at Costco if you know your prices well. But there's a lot of things at Costco that aren't a deal. They're just bigger, right? You're paying the same price you would buy in smaller quantity in a larger quantity. And if you know your prices, you can figure that out. A lot of people, Costco makes a lot of their money selling toilet paper. It's not particularly well priced. But arguably a whole Costco store is set up and designed in a way to make you want to buy toilet paper there. And a lot of people buy, and you're really not saving any money buying toilet paper from Costco. They surround it by other toilet paper that has high prices next to it, makes their price look good. And then people buy the toilet paper there. But at the end of the day, your price per roll is actually a lot higher than you would if you shopped around. So just got to be careful. There's other things at Costco that are phenomenal deals. So if you're skeptical and keep that in mind, one of the things that I noticed early in the pandemic, Costco started delivering. And I thought, oh, you know what? I don't need to go into Costco. It's actually kind of a pain in the butt to go into a Costco store. Logistically, like the parking lot's not great. The in and out of the store is not fun. So I'll just have it shipped. Well, it turned out that the prices online were different than the prices in the store. And so I caught on to that after my second time, and I stopped doing that because, all right, so I'm okay with having it shipped, but I don't want to pay more for that privilege. So, keep that in mind. Avoid leasing and payment plans. Car leasing, for example, people will say, well, it's cheaper to lease. Well, the reason it's cheaper to lease is you're leaving more cost later in the car's life. As soon as you don't buy something outright for the purchase price, you really don't know what you're paying anymore. If you leasing, I call it's a financial mirage. It appears to be cheaper, but really in the long run, your total cost of ownership is cheaper. If you were to buy the vehicle outright, finance it yourself with your own monthly payments. You don't need their monthly payments. And then you know exactly how much you're paying for it. You know what the interest rate is. It's all very clear to you. One of my first jobs, worked in an office. We sold office equipment, and the salesman earned a higher commission if they could get the person on a monthly payment plan rather than buying the equipment outright. Why? Because once we had them on a monthly payment plan, we could increase their payments, and they really had no idea how much they were paying for the equipment anymore. We could go in and upgrade them and say, hey, let's put all brand new equipment in here. We'll raise your payments by $20 a month. Is that okay? Sure. They had no idea how many years worth of payments they were agreeing to. As soon as you get people on monthly payments, then you can make more money off of them. And so don't be that person somebody's making more money off of you. I had to buy a furnace and an air conditioner, and the salesperson was hell-bent on making sure I was going to rent it. Don't rent your air conditioner. Don't rent your furnace. You don't rent your fridge. You don't rent your dryer. You don't rent your oven. You buy them. Ontario is the only place where we rent water heaters, right? Because some company got the idea of, hey, let's just rent these things. When you pay your water heater rental, mostly what you're paying is a service contract where they'll show up 24 hours a day and fix your water heater for free. The problem is you probably don't need a service contract on your water heater. They're pretty reliable. And if you have a breakdown, you can just pay for the service at that time. But if you're paying $300 a year to rent your water heater, $200 of that is a service contract that you're probably not using. So it'd be better if you just bought your water heater and then paid for service when you need it. All right. But the fact that they signed you up on a rental plan, you actually have no idea what you're paying for in that. So avoid those things as a consumer. The sooner you start avoiding those things, the sooner your wealth frees up in the future. All right. Maybe a little more expensive up front, but at least you know what you're paying for, and you can get away from some of these financial mirages. The other thing that I avoid as much as possible is monthly subscriptions. The whole world, actually, marketing people have caught on that subscriptions are better. They're even putting companies on them. So you used to buy Microsoft Office. Now they just want to sell you a subscription for $99 a year because you're going to pay way more for it over the time. You're always going to have Microsoft Office for the next 20 or 30 years. So they can get $3,000 from you over that time period. And if you bought it, you would have paid $500 or $700 for it every once in a while. And you're going to they'll probably get twice as much money from you on a subscription plan, especially since they can take that $99 and make it $119 later on. And you probably don't notice. So again, try to avoid those things, because you're essentially, by signing up for a subscription today, you're spending your future wealth. And if you keep spending your future wealth, when you get there, you don't have any of it left. So try to avoid signing up for subscriptions. There's 2 points on here. First of all, let the Joneses win. My wife and I, when we were, over the years, we had, just like you, we had some tough years. We had a young family at one point, and our income wasn't that great. And, we were like everybody else. We had a ton of debt, and we were just getting by. And you look around and go, wow, how does that family have, a new swimming pool, a brand new kitchen, and 2 new cars? How do they do it? Well, the answer is they can't do it. They're up to their eyeballs in debt. They can't sleep at night. They're crying themselves to sleep at night. But on the surface, it appears that they're doing really well. Well, there's no magic to it. And so they probably don't have that much more than you do, but they're spending it like they do. And you have to be able to stand back and say, what's important for me is this, this, and this. And if I have to deal with the old kitchen, or if I have to deal with an old car that, isn't the latest and greatest, I think that's probably still the right call to do. Don't try and keep up. Try to avoid that feeling of pressure. That there's a lot of us that feel that, including me. And it's one of those things where you've just got to stand back and look at the bigger picture. And so try to avoid that. And if they want to win, just let them win. You're in the long run, you're really the winner if you're able to stay kind of out of that race. The best way to win that race with the Joneses is to not compete. And the only other point, and these are kind of unrelated, but these are things that I came across as I did my spending or my analysis. When it comes to spending, there is a bit of a life cycle to it. Early in your career, early in your marriage, early in your family's life when you have children, there's more money going out than you have coming in. And it's going to be really difficult to save in those time periods. Once you get on the kid treadmill, your daily life, just keeping up is like, you're just existing. You're just maintaining. We had 3 young kids. And, for 10 years, I remember my wife and I, we were just managing a house. And I managed the money and we had a fair amount of debt and we really weren't saving enough. Eventually you come out of that. Eventually the kids become less work and eventually they become less expensive. Mine are now mid-20s, so and more financially independent. And so I'm finally seeing from a different perspective. And I can promise you, if you're in the middle of it right now, that sunnier days are coming. All right. And you will be able to save more and do more things in the future. And maybe then you can do the kitchen and take the big trip. But because it does get better. But in the middle, I recognize that we all have the same problems. And it's difficult in those years when, you just have to spend the money. It's not really negotiable. The kids need clothes and they need school trip money and you got to buy groceries and you're just on a treadmill. And I recognize it's difficult to do. We're still going to try and give you some tips about what you can do to optimize that and better your position. But at the same time, you might just need to give yourself a break too. You're probably here because you're probably thinking, I'm not saving enough money. I need some help. I need some tips. And so we're going to try and do that. But you should also recognize that kids are expensive and the beginning of your life is expensive. And over time, those expenses tail off. And so you'll be able to catch up a little bit then. And so it's just some perspective, something to think about. So if we talk about spending, now let's talk about savings. And so we've got this formula here, which explains how savings is calculated, right? You have your earnings and you subtract off your spending, and that equals savings. And I don't think anybody can argue with that. I'm a finance professor and I'm a CPA, so I can tell you from 2 different perspectives that that's mathematically accurate, that formula. However, I do want to make an edit to it because there's something I'd like to change about it. I'd like to change everything about it because that never works. If you wait till the end of the month to see how much money's left over and how much you can afford to save, I've never even met you and I know what the answer is to that question, right? And it's the same answer as it would have been for me. It's tough, right? Saving has to be a decision. You have to recast this formula. The corrected formula, and it's in behind our teletyper in behind here, but it says earnings minus savings equals spending. So earnings is what you earn. You have to decide how much you need to save. And then that determines how much you can afford to spend, not the other way around. You don't figure out what your spending is and then solve for how much you can afford to save. Because if you do it that way, the amount's going to be zero, right? You have to say, look, in order to hit my goals, I need to save this much. And you might have a financial professional calculate that for you, right? If I want to retire with $2 million retirement money, and you probably do want to retire with $2 million, just so you know, then how much do I have to start saving now, right? What's the number I need to start putting away? Somebody can calculate that for you. Anybody that's gone through business school, if they remember their business math, can calculate it for you. And a financial advisor can calculate it for you. So they'll give you the number. That's how much you have to save. So your earnings minus that number tells you how much you can afford to spend. So, and I remember to this day, about 10 years ago, my wife and I sitting down and saying this very thing, and we worked backwards. We inverted the formula. And it's actually when you finally decide that you're going to save, and here's how much we're going to save, you actually start to feel a sense of control. You're not just on that treadmill anymore. I had a guy I used to work with. He said, if you don't have a goal, any plan will get you there, right? And I guess that's true. You're just wherever the wind blows you that day is where you're headed, right? You got to have a goal. You've got to have somewhere you're headed, and then you can make sure your plan is going to get you to that place. But if you don't have an end target in mind, it really doesn't matter what your plan is. Any plan is fine. So how are we going to get there? Let's do a quick review on something. Compound interest is a miracle. It is what helps everybody retire. So I read a book when I was 18 called Start with $1,000. And they said, if you don't have $1,000, then go save $20 per week for a year and you'll have $1,000. And the argument was anybody could save $20 a week, right? If you really think about it, if you just at the beginning of the week snuck $20 out of your wallet and hid it away every week, you probably wouldn't miss it. So anybody can save $20 a week. I heard another presenter one time saying a kid from McDonald's making fries could save $20 a week. And I think it's hard to argue that you couldn't save $20 a week, no matter what. So that's $1,000 per year. Take that $1,000 per year, invest it at 10% for 50 years. So you're going to put a new 1,000 in every year, 50 times. And with compound interest, that $1,000 a year for 50 years accumulates to $1.1 million. Now, keep in mind, you've put in $1,000 50 times. So you've put in $50,000. That's it. You have $1.1 million. So arguably, the $1 million is all compound interest. It's all the gift that's been given to you essentially for free. All you had to do was give up use of that $1,000. And you get it back later. You get the $50,000 back later on. It's part of the 1.1 million. But in addition to your 50,000, you get an additional $1 million. That's a pretty good deal. Now, the problem is, and while I've never met any of you, I'm willing to bet that not too many of you are 17 years old. If you were 17 years old, then you could just run this program. Easy. Save $20 a week each year, put away $1,000 at the end of each year for 50 years at 10%, and you'd be sitting on $1 million when you retire. All right, that'd be easy. And it's the simplest way to save for retirement. Problem is that when we're 17, nobody told us this. And now we've got too many other things to worry about. So what if we wait 10 years? And I just want to show you the impact on the math. So if I do the same calculation, 1,000 per year invested at 10%, but this time for 40 years, it accumulates to 400,000. A huge drop from the 1.1. The bulk of the 1.1 million was made in the last few years. And that's the time value of money. That's the compound interest. That's the compounding part. So when you cut the last 10 years off, you cut off more than half of the money. All right, but it is what it is. We're 27. We're going to start to save our $1,000 for 40 years. At least you got 400 grand. So you're going to put $40,000 of your money in and you get 400,000 out. That's a multiple of 10 times. That's a pretty good deal. All right, so that's not too bad. Now, there's one other thing I did do here, though, is I used 10%. 10% is a bit of an aggressive rate. It's difficult to earn 10% year after year after year after year. Most financial planners would suggest that you use 6 or 7%. So if I use 7% instead of 10, 1,000 per year at 7% for 40 years, that accumulates to $200,000, which is half again. So when I cut the interest rate by 30%, it cut our money, our output, our accumulated value by half. So we're very sensitive to the interest rate. And so there's two messages on this slide. First of all, the longer the time, the better, the richer you'll be. And the higher the interest rate, the better. And you're really sensitive to both of those things. When you cut them just a little bit, it makes a big difference. Now you go, wow, 200,000, that's really small. Yeah, but you put 40,000 in and at the end, you've got 200,000. That's a 5 multiple. That's still pretty good. You've taken that 40,000 and you've turned it into 200,000. You've essentially multiplied it by 5 times. So this compound interest is still working for you, just not working for as long or at quite a higher rate. And if you can get 10%, then you're going to be even better off. All right, every extra percent you can get is worth a lot of money to it. And we're going to talk about that in a minute when we get to fees, just doing a time check. Okay. Got to move ahead. So saving, it's got to be a decision. You want to pay yourself first. You've heard that before. It is the only way this works. It's the most important thing you're going to do. And even if you just start with $10 a pay going to savings, it doesn't matter how small it is. The act of doing it will make you feel better. You start to feel more in control. Yeah, $10 isn't very much, but you can raise it later. Then go back in and change it to $100 once you get comfortable with it. And you can always spend it if you need it, but ideally you put it somewhere where you'll never spend it. Ideally, you really hide it away. If you put it inside of an RSP where there's a tax consequence, if you take it out, some sort of pain to help keep you honest, right? The idea is to borrow. One strategy, and again, I learned this in that start with $1,000 book, was to go borrow money, invest it, and then pay back the loan. Did two things for me. It built my credit rating, but it also forced me to save. And really, that's just what buying a house is. You borrow a bunch of money, you invest it in the house, and then you pay the mortgage back over time. And it's forced savings. Part of that mortgage payment is your equity. And gradually, you're saving money. You want to borrow, invest the money somewhere else, and then repay the loan. And that forced savings, even when we had babies, even when we were financially in debt and things were financially fairly bleak at one point, we paid our mortgage. We were still, that forced a discipline on me that gave us our savings. And so I was still saving, even in those hardest times, we were still saving. That mortgage forced us to do it. And that's why they say that owning a home is the cornerstone of financial planning, mostly because it forces people to save. You could rent all your life as long as you also save, but most people don't have the discipline for that. So when you buy a house and you end up with a mortgage, that forces the discipline of saving on you because you got to pay your mortgage. And when you pay the mortgage, part of it goes to interest, part of it goes to your long-term savings. And so that's the difference. And that's why it's there. We'll talk about an emergency fund, but you've always heard someone say you should have 3 to 6 months worth of expenses sitting around in an emergency fund. I don't know if somebody who can do that, if there's people out there who can actually do that, they're probably not fun people. All right. You're probably not good at parties, but at the end of the day, it's important to at least have some sort of a plan. I can tell you for me, when we were in our tougher years, my emergency fund was an empty credit card that I could use if I needed it to. Right, that was my emergency fund because I didn't have any excess cash sitting around. But I'm going to show you something in a minute that will serve as your emergency fund if you can get there. Another idea is to save your bonus or any found money. So what I did when I became a manager is I started to get an annual bonus, and it was a pretty consistent. We got it every year. And I said to my wife, we're not going to spend that. I'm going to put that in an RSP. And so we did that every year, and that made a big difference. And with time value of money and compounding since then, it's a significant portion of our savings. So, if my base pay was already being spent, the bonus came in, all right, that goes to savings. Let's not even look at that, right? And you just send it directly to savings. You don't even try it because you can always come up with a reason to spend it. You can always come up with a way to spend it. But you send that. Another strategy there is to, next time you get a raise, whatever the raise is, if the raise works out to $20 a paycheck, we'll take 10 of it and put it in savings so that you split half the raise you get to keep, the other half you get to spend later, but you save it for now. And every time you get a raise after that, increase the amount you're saving. So you divert the extra income so it doesn't affect your current spending, but you start saving with the incremental, right? It's just a strategy. You're just tricking yourself into saving money. If you ever watched Gail Vaz Oxlade, she used to have a bunch of TV shows where she dealt with people with personal financial planning, and she'd spend the first few bits of the show yelling at people and belittling them. But she always got to a point where she showed them a bunch of jars, and every week you were going to put a certain amount of cash in each jar, and that's how much you could spend on groceries. That's how much you could spend on entertainment. And when the money was gone, the money was gone. So she was teaching you to live on a cash basis and not live on credit. And so one of the things that between my mother teaching me and something I've invented, I created digital cash jars. And for me, it's not so much, this isn't for long-term savings necessarily. It's for expenses that are predictable. Expenses I know that are eventually coming, and I'm saving up for them. So every single time I get paid or my wife gets paid, I have it set up that a certain amount of money just transfers automatically to my Canadian Tire bank accounts. And in this internet age, you can set up as many accounts as you want. They're free, there's no fees. And so this is just a screenshot of my Canadian Tire bank account. So I have 9 of them. You know, we save for Christmas, car repairs, appliance fund. Car repairs, you don't know when they're going to be, but they're inevitable. You know, we save about $200 a month for car repairs. And this balance has gotten up to about $2,000, and then I spend it and goes back down, then it goes back up to $2,000. But I can't tell you the peace of mind that comes from knowing when my engine light comes on in the car and I take it in the shop and they haven't called me yet and I'm waiting for that call to tell me how expensive it's going to be, the peace of mind that I have because I know that I've got, you know, right now $700 sitting in this account, it just makes you feel so much better. You feel so much more in control. And I don't care if you put $2 in each of these accounts every pay, just start it. You can raise them up later. Just any amount you put in there, it starts to make you feel in control. And then you can raise them up to something that's more appropriate. It started when I was 18. My mom said, you know what? Christmas is not an emergency. Give me 12 post-dated checks for $80 every month, and I'll give you a check back for $1,000 at the end of the year. And you can spend it, right? There's no reason to end up with a credit card bill after Christmas. I save all year long. We got money in the account, and then we just pay cash for everything at Christmas. Christmas now becomes, I'm in control. I don't have a $2,000 credit card bill in January to deal with because I'm out in front of it, right? So these digital cash jars, again, none of this is long-term savings. It's all going to get spent. My insurance bills, my property taxes, like it's just stuff I know it's coming, but I'm saving for it gradually. So I don't have these huge lumps I have to worry about. Every time a bill comes due, I just transfer this back to my checking account, pay the bill. Right? Can't tell you how valuable I think this particular tip is to set this up. And once you set up the first account, opening up multiple accounts is easy and it's free. The first one's a bit of a paperwork hassle. So once you save some money, checking my time, next thing you got to do is invest. And this is where I'm just going to scratch the surface on a bunch of ideas. In the end, you probably want to have an advisor. As I said, I'm a bit of a lifelong learner on this. In my last 2 jobs, I was responsible for managing large amounts of corporate cash, about $500 million in one job, and in the last one, about $800 million. At the last one, the $800 million, we broke it up and we farmed it out to different professional money managers. So people that specialize in managing certain types of investments for companies. And these guys would come and see me every quarter and tell me what happened. And tell me, hey, this is our results. This is our asset mix. This is why we own these stocks. This is why we sold these ones. Smart guys, smartest guys I've ever met when it comes to investing. These guys are Canadian experts. We hired the best guys in the country to do this. I cannot tell you how impressive these guys were. They were able to explain things in simple terms. The smartest people can explain things in simple terms. If you start dealing with someone who deals a lot of lingo, then they may not know their stuff and they're hiding behind big words. These guys were good. However, when we looked at their returns over a 5 to 10 year period of time, once you backed out their fees, I would have just been better off buying the index average. None of them over a long period of time were able to beat the index. Yet these are the smartest, best investors in the country, as far as I'm concerned. All right. So with that in mind, I learned from that and said, you know what? I'm not going to try and beat the market. I'm just simply going to take the market returns. And you can buy simple index, we'll talk about them in a minute, exchange traded funds. And if you don't know what those are, if you ever knew what a mutual fund was, where you just buy one thing, but you're essentially, that thing owns a whole bunch of things. You can buy the whole Canadian market in one ETF. It's a exchange traded fund. It trades like a stock, and you can invest in Canada. So I manage my mother's money, my wife's money, and mine. Okay, it's my mom. Okay, I'm telling you what I'm doing with my mom, and we decided on the asset allocation. She has a little bit invested in Canada, a little bit invested in the United States, a little bit invested in developed markets around the world, and a little bit in emerging markets around the world. Argentina, Brazil, China, India would be the emerging markets, especially China. China is a huge opportunity. And so how do we do that? We bought 4 different ETFs on the Toronto Stock Exchange, and we'll just buy it and hold. We'll own those for 20 years. All right. Passive investing, the fees are practically zero. And that's the second point. Fees matter. So you would hear a lot of ads now on TV talking about the high fees are killing us, right? This has been true forever. It's just that there's companies now willing to do this work for low fees, or almost no fees is the strategy that I use. Here's the way you think about it. If you use a full service investment company, their investments will charge you about a 2%, maybe 2.5% fee per year of your total balance. Now, let's say your investments are going to grow at 5% and they charge 2% in fees. What that means is that of the 5%, 2% goes to them, 3% stays with you. So they're taking 40% of your profits, you're keeping 60. Now, remember my example of $1,000 a year for 50 years grows to 1.1 million. Out of that, you put in 50,000. The whole growth was interest or investment income, right? The whole $1 million was the investment income. What I'm saying, if you let them charge you a 2% fee, they're going to take 40% of that. You keep 60. So your 1.1 million is now down to 600,000. If you're okay with that, then by all means use a professional full service advisor. But I think that's overpaying them. I think the service they provide is phenomenally valuable and you need some professional advice, but there's better ways to do it. You can hire what's called a fee for service advisor. You have to pay them up front. So you write a check up front, which is the reason why people may not like it. But maybe you pay them $2,000 and they help you plan all of your investment strategy, your investment allocation. They help you optimize your tax situation, which is huge. You get all organized and then you just run the plan yourself. And you write a check to them once and then you invest in something that has very low fees and you save that 40% doesn't go to somebody else. You get to keep it all. Right? My fees on my program on my investments are around 0.1%, right? 0.1%, not 2% anymore, not 2.5% anymore. Okay. So because I want all the money for me. And so there's ways you can do that. Now, I listen to some of these guys and they make a good point. They say, you need to pay us that 2%. You know why? Because if it wasn't for us, you wouldn't save the money. You wouldn't have the discipline to do it. And even worse, you would panic sell when the markets dive and you would sell low and buy high and you'd have very little left to retire. And if you know yourself and you know that's the case, then you probably should pay them the 2%. All right. So it's better to have 60% of a big number than 100% of a really tiny number. All right. So there may be good reasons there. And I agree with them. If you don't have the discipline to do this yourself, if you don't have the discipline to save, you need someone else to keep you organized and to force you to save. And if you don't have the discipline to buy something and hold it and ignore the ups and downs, then maybe you do need them. Right. So it's something you have to think about. This isn't one size fits all for everybody. Stock markets are for money you don't need for 10 years or more. Right? Don't think about it. It's not for money you want for 2 years from now. It might be down 2 years from now, but 10 years from now, it's probably going to be up, right? 10 years from now, it's probably going to have doubled, but we just don't know in a short period of time what's going to happen. But over the long haul, I expect the market to double about every 10 years. All right. That's every 10 to 12 years, I would expect stock markets to double. Okay. So at least the mature sections of those stock markets. So that's my goal. But every 12 years, it should roughly double on average. Okay, there'll be ups and downs to that, but that's a rough average. Buy and hold and reinvest your dividends. If you have investments that pay out dividends, don't take the dividends and run and spend them. Remember, that's the accumulation that gives you that $1 million at the end, right? You need to leave the dividends in, right? That's the compounding effect. You can't put in the $1,000, get a $20 dividend, take the $20 and go buy a sandwich with it. You got to leave the $20 in. And now you have 1,020. And then it pays another dividend the next year. Now you have 1,050. And the snowball keeps getting bigger and bigger, right? And eventually the original 1,000 is irrelevant. Eventually your investment income is so big and you're earning investment income on the investment income. Couple of things just to keep in mind, and we don't have time to go into the details, but there's different types of investment accounts. So you can have registered accounts like an RRSP that simply defers tax to later. So you get a tax break when you put the money in, but you have to repay the tax later on when you take it out. You have a tax-free savings account that you never pay tax on. The one tip on a tax-free savings account is make sure you put investments in there that are going to grow. If you just put money in a savings account inside of your tax-free savings account, you're missing the point. The point of a tax-free savings account is that you don't pay tax on what you earn, on the growth. Rather, in your RSP, you're going to pay tax on all that growth. In an investment account, you're going to pay a capital gain on all that growth. You're going to pay tax on that. In a TFSA, you don't have to. So the point is, if you had two stocks you were going to own, and one of them you expected to double 2 times, and the other one you thought was just going to grow a little bit over the next 20 years, but you want to own them both, well, you put the one that's going to double 2 times inside your tax-free savings account, because you'll never pay tax on all that growth. And you put the other one in your RSP, because the low growth, yeah, you're going to pay tax on it, but at least you're only paying tax on a small amount, right? So you want to try and manage those tax issues. And if you're not comfortable with that, you need advice. Get a fee-for-service advisor. Tax planning is one of the most important services they can provide for you. And if you have to pay them $5,000 up front, it's worth it, because it'll save you $150,000 later, right? It's a lot of money. Taxes is our last topic. Just checking my time. I have 3 minutes. Perfect. So just a few tips related to, and most of them are sort of COVID related this year. So it's tax time, this time of the year. Your tax return, if you're an individual, is due April 30th. If you have a small business, it's June 15th. Here's the first most important tip. Make sure you file your return on time. Even if you owe money, you don't have to pay them on time. Just file the return on time. If you file your return on May 1st instead of April 30th, and you owe them money, let's say you owe $2,000 in taxes, they're going to ding you with a 5% late fee. Just a one-time 5% fee. So your $2,000 just became $2,100. Don't give them the $100, right? It's just free money to them. File on time, even if you can't pay anything, it doesn't matter. Just file on time. It's the not filing that causes the filing penalty. Now, you're going to pay interest after that for sure, but you were going to pay interest back to April 30th anyway. So not filing on time doesn't get you out of interest. So you might as well file on time, save the filing fee, save the $100. I usually am in this situation, as long as you don't owe more than $3,000, it's no big deal. So because I often have some advising income that I earn where I don't have tax deducted, withheld, I usually am in a situation where I owe a bit of tax. But as long as it's not above $3,000, they don't worry about it. If it's above, they start saying, hey, maybe you should be paying us tax in advance in installments. But you can go up to $3,000 without it being a big deal. Just make sure you file on time. Okay. This year, the government's trying to support newspapers because they're going out of business everywhere, right? The internet's killing them. But it's important that we have a good press. So they're trying to support newspapers. And the way they're doing it is they've created a deduction called a digital news subscription. So if you have a digital news subscription to a Canadian source, so we have like Apple Plus or something on my iPad where it's a news thing. Well, that's being paid to Apple. It's not Canadian. So that doesn't count. But I also have a Globe and Mail subscription that I pay. I have an online access to the Globe and Mail every day. That's a Canadian digital news subscription. That's tax deductible this year, up to $400 or $500 or something. You can you can deduct. Now the thing about it is that apparently the news outlet has to apply to qualify for this. Then you can deduct it. I looked on the Globe and Mail website. I can't see anywhere where they talk about if they're an eligible subscription or not. I'm just going to deduct it. All right. It's deducted if someday the government looks at it and says, oh, what was your subscription? Oh, the Globe and Mail wasn't eligible. We're going to reverse that. Then they'll reverse it. But they probably will never look at it. I'm going to deduct it on my return. In some cases, so by I mean some cases, if your income last year was $75,000 or less, and you received any of the COVID benefits, the CERB, any of the other ones, there's about 6 of them. Most people got the CERB, and you owe money on April 30th. So you figure out your taxes, you owe money. Let's say you owe $1,000. If you received CERB last year and you earned less than $75,000 last year, which would be most people, you have a whole extra year to pay your tax bill without interest. Whoa. So that's when I got excited there and my finger touched my mouse pad. You have a whole extra year to pay the interest. So you don't have to pay it this April 30th. You have till next April 30th, but it's only if you qualify. If you receive the CERB or some of the other COVID benefits and you earn less than $75,000 and you owe, then you have a whole year to pay. You don't have to pay it April 30th. So that's good news too. Another reason just to file on time and don't worry about paying, okay? Pay it when you can. Also this year, you get specific to this year, and it may be next year as well, home office expenses. You can deduct $2 per day that you were forced to work from home. If, like me, I'm working from my dining room table right now, right? So I normally am at the college on the middle of March last year. They closed and said, go home. So I've been forced to work from home. So this year I can deduct $2 per day for that. I had to go through and calculate the number of days. So I went through the calendar before this and I came up with, you don't get to deduct holidays. So I came up with 201 days. The maximum's 200. So I'm going to take 200 days times $2. I'm going to take the full $400 deduction. The good news for people who understand tax, again, this is a tax deduction, not a tax credit. So it's worth more to you, okay? Tax deduction, it saves you money at a higher tax rate, your highest tax rate, not the lowest one. All right, so for me, it worked out to $175. Not bad, I'll take $175. My wife's also gonna get $175. So between the two of us, we're getting $350 back as a result of that deduction. Save and invest tax efficiently. Again, this is where you want to sit down with a fee-for-service advisor. If you just Google fee-for-service advisors, you will be able to find a bunch. You can also go to the financial planning societies. So this CP, I can't think of the designation. It'll come to me later on. But you can go there to their websites and they'll have lists of people that are registered with them. It's good to work with somebody who's registered because then you know that they've got a code of ethics that they're adhering to and that they have continuing professional development, that sort of thing. So it's good to, I don't have that designation, but you know, those personal financial planning folks, it's good to maybe go, if you go to the website, you can put in your city and they'll probably give you a list of people in the city who are registered, who are practicing. So they'll help you put in touch with someone who can do that sort of thing. Or you may know somebody. I know a couple of people who do fee-for-service investment advising. So you probably want to have somebody sit down. Again, it's worth it for the tax savings alone, making sure that you make the right decisions now. You can't wait till you retire and say, okay, now how do I save tax? It's too late. You needed to plan 20, 30 years ago and set your things up in a way that will be tax advantageous later on. So you want to have someone advise you early and set you up properly, and then you can run the plan by yourself, right? But make sure that you get that advice early, and because just the tax savings alone can save you $100, $200, $300,000, right? Just by being organized from a tax point of view, it'd be significant value. So with that, I think we're ready to move to the Q&A section. I apologize for moving so quickly because I know that there'll be things I didn't explain fully enough, and really it just would create more issues, more questions than answers in some cases. But it was, given the limited amount of time, I thought that's the best way to use our hour, and then you can figure out where to go from there. But it might be attention directing. So with that, I will turn it back over to Lynn. And if you've got any questions, we can try and deal with some of those.
Great. Thank you so much, Michael. That was fantastic. So many practical tips you shared and a really refreshing, simplified perspective on approaching your saving and budgeting. So thank you for that. So at this time, we'll turn it over to questions. We received a few questions in advance, so a big thank you to those who submitted them. And if we're not able to address all the questions today, you will receive a response by email. Michael has also generously offered to stay on Zoom after today's webinar for an informal Q&A for those who would like to dive deeper into specific topics or have more questions for Michael. So the first question we received, Michael, is, what is the most effective way to increase credit scores? What advice do you have for couples? Should all accounts be joined?
All right, so two different areas there. On this question, I have a friend of mine who runs a business dealing with credit. And so I asked him, and he flipped me back a website that I could have found on my own. I was kind of hoping for his inside information, but at the end of the day, there was 3 key tips that they gave me on this website about rebuilding your credit or improving your credit score. All of a sudden, my mind's going blank on it. The first one was, pay your bills on time, right? So a track record of paying your bills on time, your hydro bill, your water bill, whatever you've got, pay those things on time. Your credit card bills, always make the minimum payment. They don't, it's only $10, but that $10, as long as you make that minimum payment, they'll always report you as current. And so make sure you pay your bills on time. The second thing was avoid opening new credit if you can. So every time you open up new credit, it pulls your score down. The third one was use less credit. So a third of your score, he said, is the percentage utilized. If you're using 80% of your credit lines, that affects your score negatively. If you're using 10% of your credit lines, that affects your score positively. So try and use less credit. Try and open up fewer new accounts. Don't add more accounts if you don't need them, and pay your bills on time. He said, by far, that is the most impactful way to improve your credit score. In terms of joint accounts can be really handy. We're going through this now. My stepfather just passed away. And so one of their long-term savings accounts was a joint investment account. If you have someone that passes away, what happens is you tell the bank, and the bank immediately freezes all their accounts. And so if you were a husband and wife and all the money was in an account that the husband controlled and the wife wasn't joint, as soon as the bank finds out that the husband's passed away, instantly they will freeze that account, and it might take you 2 months to unfreeze it. So the joint account, what it lets you do is it lets you access those funds seamlessly. So my mother, all their bank accounts were joint. So my mother has full access to those accounts throughout. They weren't frozen. So it simplifies that process a little bit. From a estate planning point of view, for the example, that investment account that my mother and stepfather had jointly, when my stepfather passed away, because it was joint, now it's just my mother's money. It transitions directly to her. It doesn't go through the estate, and so you don't have to pay probate tax on it. But if the money was not in a joint account and it was an account in just his name, then that would go through the estate, and we'd have to pay about a 1.5% tax on it before it passed out through the will to whoever the beneficiaries were. And the beneficiary would have been my mother, but if it's joint, it just passes directly, and you can avoid that. First of all, it's seamless. She has access to it right away. And second of all, you avoid the probate. So there's benefits to the joint account. Depending on your situation, though, a joint account may not be appropriate. So, there's downsides too. It also means the other person can spend all of your money, right? So you have to, know that you're the person that you're joint with extremely well, and be sure that everything's under control that way. Next question.
Great. Thank you for walking us through that. So the next question, we just have time for one more. What taxes do you need to be aware of if you are wanting to start your own business and selling goods or art? What forms do you need to look at for self-employment?
Okay.
With regards to taxes.
Yeah. So it's not my area of expertise, but the one thing I can tell you that the most important tax that always catches people and even catches big companies by surprise is HST. So you're thinking about income tax, and that's important, but you should probably get some specific advice on that. You have to fill out the income tax forms that are related to a small business. Again, I fill them out for my own little business entity that, some of the work that I do, but it's not very sophisticated. And you probably, especially since you're talking about a business where you're going to buy and sell inventory, you probably want some specific tax advice. You should see a professional person who does taxation for small businesses. Make sure that they have that specialty. But the one thing you want to keep in mind is HST. So you're going to have to bill HST and collect it. You also get to deduct the HST that you've paid against that, and you have to remit the difference. And so getting that set up early and making sure that you're collecting it is important. And so you'll have to apply for a business number with the government, and that business number will become your HST number. And you'll want to just go on the internet and say, and Google setting up HST, or do I need to register for HST? And you'll start to see the steps that are required. And that's probably one of the more complicated ones. And when you really get into the HST stuff, it can get very complicated. I know people who've made their whole career just in explaining the detailed nuances of HST to companies. Right? There's lots of little things to worry when you get into expense reports, and what happens when you pay HST on a restaurant bill. And but at the highest level, you just want to get registered for HST, make sure you're collecting it properly, and make sure you're remitting it properly, because the penalties on it are very high for not doing it right. Okay, so make sure you jump on that.
Great, thank you so much, Michael. As we near the end of the hour, we do need to wrap up. If you are available to stay on the line, Michael will be taking additional questions during an extended, more informal Q&A. So feel free to stick around if you can. I want to thank you again, Michael, for your presentation today. We really appreciate you taking the time out of your day to share your insights on personal finance. I know I personally learned a lot, so thank you for that. And as we wrap up, I just want to mention a few other upcoming virtual events available to Mohawk graduates and students. On March 18th, Mohawk Alumni is hosting a TV show themed trivia night, and there will be an alumni prize pack up for grabs. Every Monday, Wednesday, and Friday throughout the week, you can participate in yoga and meditation classes. And on April 7th, you can join us for a webinar on starting your own home garden. So to sign up for these events, please visit the website mohawkcollege.ca/alumni events. Thank you everyone again for joining us today and for staying connected with Mohawk. I hope you enjoyed this beautiful sunny Wednesday. Bye for now. Take care, everyone.